welcome to the quarterly context webinar for the second quarter of 2017 for clients of the advisory group and WealthStep. WealthStep is a division of the advisory group that provides a simplified service for up-and-coming clients. Our quarterly context webinars are designed to provide high-level perspective regarding the economy, markets, investor behavior, and other factors to help both our personal wealth and fiduciary clients better achieve their goals. And we try to keep these meetings to about 20 minutes, and we'll circulate a video link afterwards should you like to view some portion of it again or to pass it on to someone who you think might find it helpful. If you have any questions, please submit them to the question box, and we'll try to address those either during the presentation or at the end. So let's get started. As a reminder, it's always most critical to first focus on what's most important to you, what matters, and the elements that you can control. Markets, for example, are not controllable, but your asset allocation for long-term design to accomplish your goals are, as well as other factors that you control. If your objectives have changed, consider contacting us or reevaluating your strategy to make it more consistent with your needs. In terms of a market overview, we can see here that markets across the board were positive during the second quarter, particularly strong in the developed markets or international developed countries, and most strong in emerging markets as they made a bit of a continued rebound. The developed markets, Europe and other areas, have been making a bit of an economic and market turnaround, a bit of a delayed effect after the global financial crisis, where the U.S. had heavier stimulation early on, and then Europe was delayed in following a similar approach and is now getting some of the benefits of that. Bond markets were up, both U.S. and abroad, a little bit higher than the long-term expectation in terms of the U.S., given that some of the bond rate movements and for the year, you can see that also affected, created a negative return. Other notable elements for the quarter in terms of markets were that the NASDAQ went over 6,000 for the first time ever, and not too long ago, actually during the third quarter, rather than the second quarter, the Dow for the first time went over 22,000. I think that was just a day ago, maybe even yesterday. Additionally, there are patterns in terms of style or value underperformed growth for the quarter. International value also underperformed growth. Oil was down about 10%. That's been a volatile area. Gold dropped as well. Gold is really just a fear asset, not a true asset allocation design element. And that gives you some sense about how the markets have been behaving recently. In terms of market headlines, there's always headlines every quarter that tends to move the market up and down in bits and pieces. In the long run, most short-term news blends right into and has very little impact on the long-term returns. But some of the recent news were related to confidence with the NASDAQ soaring, the Euro region confidence increasing. Household debt also reached a high, which is indicative of higher consumer confidence, but also creates some other concerns. And with that increase in confidence in general, and talk of the Fed cooling off the stimulation program, that created concerns about the implications of less liquidity in the marketplace, less stimulation, and therefore make markets a little bit nervous and cause a little bit of a recent cooling, at least towards the end of the second quarter. More recently, markets have also continued to be strong. In terms of economic snapshot, GDP growth was relatively strong in the second quarter. However, some would estimate that may be overstating what it's likely to go forward. The Fed funds rate was increased 1/4 of a point. The Fed stated that they expect to raise later in the year, potentially one more time, at least this year. Inflation has remained fairly stable, not quite the level the Fed would like to see it. Unemployment was a bit bumpy, but ended up falling to a 15-year low of 3%. Now it's for a little while has been at full employment. Wage growth cooled a little bit recently, which has some implications for future consumer sentiment, which recently waned a little bit, and that's despite the investor optimism surging to a 16-year high. So there's a number of indications that when confidence is strong and markets have been high for a while, sometimes that precedes some extra volatility. So it's important to keep that in mind as you're focusing on your long-term strategy, and not to be surprised if there's some bumps down the road. The Eurozone also, as I mentioned before, picked up a little bit of speed. Unemployment improved materially there, and that created a bump in market returns. This slide shows a few of those same factors, but in their historical context. Here we can see how wage growth has been improving, but tapering off a little bit more recently. On a CPI or inflation measures have been relatively stable, and lower than average and lower than the desired growth rate would imply. You really see that over time, the blue line is the long-term average, and hovering above that, but cooling just a little bit. And of course, oil has taken quite a dip, quite a ways off of the 140 or so level in 2008, now closer to $43 a barrel. In terms of where we stand relative to the global financial crisis recovery, while it still feels recent to some people, we're fairly clearly out of that pattern. This is on an inflation-adjusted basis. That's why some of these other markets here, the Great Depression, 70s crisis, and the dot-com have fallen beneath this line relative to the blue line, relatively speaking, which is the current line, given that inflation was higher during those prior recoveries. So what really matters is the inflation-adjusted number, because those are the dollars you actually get to keep and spend. That said, it would be normal for this number to begin to revert closer to the historical mean, and right now appears to be overshooting that a little bit. Of course, no one can say exactly when that will happen or what the magnitude will be. In terms of valuations, with strong markets, the U.S. markets in particular are showing to be at the top of 10-year recent valuations that oftentimes precede some additional volatility. Europe, while picking up speed, still at above average over the last 10 years, but at somewhat more reasonably priced levels, as well as emerging markets, despite some of the comeback they've had. So having a disciplined exposure to these markets is proving helpful now after being lagging the U.S. markets for some time, and they still have a run. Oil is also added back the volatility index chart. This shows measurement of volatility over time. And what's interesting to see is that it's not uncommon that when markets are strong and fairly consistently strong, volatility in terms of total inflation of markets tends to cool off, and that again sometimes precedes periods of increased volatility. As you can see, after past periods of relative lows, there's sometimes a spike in volatility. So that doesn't mean you need to make an adjustment to your portfolio. It just means, in general, if your portfolio is appropriate for your long-term plans, that you need to be prepared for and disciplined to stick with it to benefit from both sides of market volatility. Regarding international, that was, as mentioned a moment ago, the long-term trend shows that value versus growth tend to take turns, small cap versus large cap. And in this chart, we show domestic in gray versus the international chart our international index here. And so we can see there have been periods here in the gray bar where, in particular, most of these are showing underperformance of international versus domestic over a number of periods, and an extended period really here since 2009. And more recently, the international market has been picking up speed. And question is, what will happen next? It wouldn't be surprising if international stocks had their turn for a while, but that can take turns during that time period. As you can see here, the periods where it trades back and forth regularly. So holding a long-term discipline approach in terms of asset allocation and diversification pays off in the long run. Going to the micro level, at the individual stock level, thought you might find this chart interesting, showing the evolution of the top 5 largest companies. And here you can see that back in 2001, which doesn't seem that long ago, only one of the stocks was a tech company. Same was the case, although some shifting around in 2006 with some manufacturing, but in particular oil being strong. As you recall, the 2008 oil price was in the $140 range, so this is somewhat related to that. 2001, still only one tech stock, although this time Apple instead of Microsoft. But 2016 and forward, it has been all tech stocks, mostly software or software plus hardware. And that is a first time and quite a shift. And there's some discussion about what that means in terms of market valuations as technology has advanced, and the scale that comes along with technology and software may mean that historical valuations averages may be a little bit less relevant than current valuations, in the sense that if you have infinite scale in terms of software, although markets are never infinite, that can allow for potentially for a higher valuation at a reasonable level. That doesn't mean that current valuations should necessarily be viewed as perfectly reasonable, but in general, software is more scalable than physical product companies. So something to keep in mind. And at the same time, given the valuation numbers we mentioned before, we still think it makes sense to be aware and prepared for additional volatility. Naturally happens at some point and oftentimes follows stronger periods of the market. And we're now in an extended bull market essentially for quite a number of years. In terms of the quality thermometer, this is where we show whether high quality stocks, where green is shown, tend to outperform for a given sector for the quarter and then for the year. And where it shows red or pink is where lower quality stocks outperformed. And if the number is shown here in the negative, that means that high quality stocks underperformed by this amount or outperformed by the positive number if shown in a green cell. So you can see for the year ended June 2017, lower quality or higher speculation stocks really had the lead, in some cases by a material margin in small cap growth, whereas more recently, with a few bumps and a little bit of wobbliness, high quality, which tends to be more stable, better cash positions, less debt in terms of the company structure, tends to have a little bit better returns and a little less downside risk. So the portfolios that we construct can contain a combination of both, but it does include quality to help create a little bit less downside in difficult markets. And here you can see the pattern over time. Over the last roughly 20 years or so, there have been more low quality markets than high. And while the last 3 years show that high quality has led, it's been maybe a little bit bumpier than that would appear just by seeing the 3 thumbs up recently. In terms of reality of red bonds, we can see that it's got a pattern here where 2 positive months and negative months, 2 positive months and a negative month. So we'll see what happens for the rest of the year. But so far that's added up to a 2.3% bond return, which is roughly about what the full year expected return is. So the full year expected return rather for a 10-year forward-looking projection. So we'll see what happens with the potential expected rate hike later in the year. It's not likely to be a large rise in rates, but that could affect markets in the process. In terms of investor behavior and cash flows, mutual fund industry-wide as one measure, you can see more over time, the pattern has been that investors tend to move in and out of asset classes after they have shifted, and oftentimes chasing markets, which helps explain the number of studies that we've referred to previously in these quarterly context meetings that show that investors on average on their own tend to have poor results because they're chasing markets. And most recently, there was a large outflow from liquidity, which is primarily money market and very short-term type cash vehicles, and the biggest increase was in taxable bonds. So just in time for an interest rate rise, and some of those investors will likely be a little bit disappointed if they're trying to get out of 0% returning essentially money market funds into what are expected to be higher return bonds. They might experience some negative returns along the way with rate shifts. In terms of a different type of sentiment than something we've referred to earlier in terms of consumers, something somewhat related but different is a study that from the Employee Benefit Research Institute that suggested, or data from that effort that showed that in general, the average pre-retirement person has decreased their confidence about their ability to retire as planned. In fact, even though this middle measure here goes up, this one is that they're not too confident. So that is increased, which means that all three of these measures show a decrease in confidence currently. Not a dramatic shift, but not an immaterial shift either. Then the lower chart shows how consumer debt has increased dramatically back up to pre-market crisis levels. And that's oftentimes tied to investor and market optimism. People feel like the wealth effect of their homes or other assets have increased. They feel more confident spending, and that can lead to more debt, in particular credit cards, as well as other debt, but that can also lead to risks. And some of that is showing up a little bit now as late credit card payments have increased. And when that happens, if that increases to a certain level, that's oftentimes followed by decreases in spending. So for people making an effort to pay off their bills, and that can create a little bit of a drag on the economy. So some of this consumer spending now may be what's pushing markets up, but if it's borrowed money, it's not the same as money that's being spent from actual wage growth. So maybe a little bit of fluffing of the artificial inflation of markets due to some of that borrowing. There's a number of studies that have indicated the value added that is provided by advisors using some general numbers, and this will vary by person and by advisor, but you might find it interesting, and have probably experienced this yourself, that through guidance, behavioral coaching, portfolio design, education, lower cost funds, access to funds that you might not be able to access yourself otherwise, negotiation on your behalf by the advisor group, your advisor, the spending strategies, total return versus income investing, and tax efficiency where relevant. All of those elements, amongst others, add up incrementally to value that studies show exceeds advisor fees, oftentimes materially. So 3 recent studies indicate that those levels of value are in the 2 to 4% range. So if you are familiar with someone who is spending a lot of time doing this on their own without a lot of results and creating a lot of stress for themselves, hiring a good advisor may be a wise choice, even if there's a fee involved, because the value, if it's a good advisor, should materially exceed the fee over time. In terms of rules and regulations, interestingly, after the Trump administration putting the fiduciary rule on hold in the first quarter, it was put into effect as of June 10th, and it's supposed to be, all of the features of it are supposed to be fully in effect by the beginning of 2018. Also, it's not fully clear, but the Trump administration also plans to dismantle the Dodd-Frank financial overhaul regulation, and that if that does occur, that can lead to increased volatility in the markets and the economy. Just very recently, actually, a few days ago, there's an announcement the Treasury decided to end, or plans to end, the MyRA program, really designed for smaller investors as a way to try and stimulate increased savings. It turns out the cost and the demand didn't work out well currently, and the administration is hoping that private solutions will be a better solution for that. On the retirement plan side, the fiduciary rule just mentioned is also relevant. I won't go into details here of the IRS pre-approval program, but you can take a peek at that later. In terms of 401k, there was a case that was initiated that with the increased use of pre-built portfolios and managed portfolios, and some of them involve outside services that are brought in by an advisor. There was a case that is suing an advisor for taking a fee from an outside portfolio management service without actually being involved with any of the work. So interesting layers there, and our clients don't have to worry about that sort of factor, luckily. In terms of WealthStep, the online tool that we're building, the current plan for the beta is August and September, and WealthStep will also have, as part of its program, occasional financial literacy education at community schools to help improve financial literacy in general amongst our community members. With that, we want to thank you for attending today, and we look forward to any questions you might have. We always want to hear how we can better support you, how we can help you and others that are like you, and we look forward to speaking with you soon.